As the US-China trade war intensifies, the question that many investors have is whether China's economy and its bond market can hold up to the strain. We speak to BlackRock's Director for Asia Fixed Income, Eric Liu, on whether the PRC can defend its title as the world's second-largest bond market and what investors should look out for. Although most expect China's economy to remain resilient, will the recent round of US tariffs change this?
We think the recent round of US tariff will not change the strong and solid economic fundamental of China.
Okay.
So if you look at the Chinese economic structure, it has changed dramatically in the past 10 years, from an investment and export-driven economy to a consumption-driven economy. And in last year, the domestic consumption has already contributed to over 70% of the GDP growth in China. And the export only account for something like 10-15% of the GDP, which is a similar level to US. And on top of that, if you look at the Chinese policy, actually this year China has implemented expansionary fiscal policy, including the tax cut and also more infrastructure spending. Actually, if there's this additional tariff, we actually expect the Chinese GDP growth this year to surprise to the upside and more than 6.5%. So even with this additional tariff, we think China can still achieve the GDP growth target of between 6% to 6.5% this year.
But what if the trade war persists? What is China's strategy after that?
So if things getting worse, say US apply another 25% to the remaining export from China to US, we expect the GDP impact will be, in total, will be around 1%. And this 1% will be largely offset by the existing expansionary fiscal policy. And if the thing is really getting much worse and the surprise to the downside, we expect the Chinese government to change the monetary policy from more neutral to accommodative monetary policy to an easing monetary policy this year. And that will be more than sufficient to offset negative impact from the tariff.
So now we talk about China's bond market, all right? It has surpassed Japan. It's now the second largest bond market in the world. How is it faring against other markets as we speak? I mean, how are the onshore and offshore markets doing?
There's one phenomenon which most of people or global investors doesn't really pay much attention to, is a correlation between the onshore market and global market or offshore market. So the correlation between the market, between onshore and the global, is very low. It's almost like a zero. For example, last year, when most of the asset class globally, including the global bond market, including the stock market, sell off, but onshore market gave a positive 8% return. The reason is because onshore bond market is mainly driven by the domestic factors. For example, the Chinese monetary policy, fiscal policy, or regulation change. Well, the global bond market is mainly driven by the policies of the developer market or the EM volatility. For the moment, with the trade war getting worse again now, and the volatility goes up, uncertainty goes up, there's a very little asset class in this world can offset this risk, hedging this risk, and give investor a balance between the volatility and the income. Apparently, the onshore bond market is one of these asset class, which can really increase the risk-adjusted return for the global investor.
So when it comes to the trade conflict, what is the biggest concern? How is it going to affect the bond market?
We do not expect the trade tension to go forever, and will resolve one day, because last long for this trade war is actually a lose-lose situation for both countries. So it's a matter of time when this thing can be resolved. So it won't be a long-term problem. I would say that the perception, there's a market perception that a trade war is better for Chinese economy, no question about it, and it's better for the Chinese capital market. It's actually not true for the Chinese bond market. So if you look at Chinese bond market, whenever there's an external factor, say trade tension, like 2018, what the Chinese government will do is that they will easing the monetary policy, which drive the interest rate in onshore bond market to come down and the bond price to go up. And that's why in 2018, the onshore bond market gave more than 8% positive return, while most of the global market gave a negative return.
Who actually makes up the biggest chunk of China's bond market investors?
The domestic banks make the biggest chunk of the onshore bond investment. So it accounts for roughly 50% of this market,
Right.
while the foreign participation is only 3% for the moment. We do not expect this 50% to grow because Chinese policymaker and the Chinese government now is trying to promote the direct financing for the corporate, which means they want to grow the asset management business and they want to grow the capital market. So we're actually expecting this 50% to gradually decrease, partially because it will be taken over by the domestic asset manager and partially taken over by the global investor in the future.
The major issues that would then affect, China's bond market, what should we or investors look out for?
I think there are two things investors should look out for. The number one is index inclusion. With a Bloomberg Barclay already included Chinese government bond and policy bank into index, and we expect the other two major index providers to follow. This will bring a passive inflow of about $250 billion into this market. The second thing we are looking at is the pricing discovery of this market is highly inefficient because this is a relatively very young market. The bond market only exists for about 10 years, and the credit market only exists for about 6 to 7 years time.
Okay.
It's very young. There's a lot of credit dislocation in this market.
So what is the current outlook for China's bond market?
I think the China's bond market has already been the second largest bond market in the world with $13 trillion. And its annual average growth rate in the past 10 years is over 20%. We expect this growth rate to continue at double digit in the next couple of years' time because the government want to promote the development of the bond market and also because the outstanding bond over the GDP is much lower in China compared to the other countries. And there's one interesting thing I want to highlight here is that although this is second largest market, its size, its growth, its complexity provide a wealth of opportunities to the investors. However, the global participation in this market is only 3%. It's very underinvested by global investors.